Hello and welcome. I'm Brett Theodos, Senior Fellow and Director of the Community Economic Development Hub at the Urban Institute. It is so good to have you with us today to look back and also forward on how CDFIs can expand lending to diverse small business owners. This is a topic that the country has awakened to and begun to see as an important gap that we need to address in our collective policy and finance and philanthropy and business spaces. But we also know that there are long-standing and durable and stark divides in terms of who owns businesses in the US. Today's conversation is built from work that we've been doing over the past year with the support of and from the Opportunity Finance Network and their support from the Wells Fargo Foundation. We've set out to document the work of several CDFIs and their experience under and with the Wells Diverse Community Capital Program, specifically the Activator Grants. And that work, which is joint with my colleagues, Jorge Gonzalez Hermoso and Jane Park, has now been published. And we will get to hear some from the voices of a few of those CDFIs today. But we will also have a forward-looking discussion about where the field's going from here to meet the needs that are very clear and very present before us. So a couple of housekeeping things, and then we will get underway. First is that this event is being recorded, and the recording will be posted online, so you can watch it again or share it with colleagues and friends. Next is that we do have a live transcript option that is on to improve accessibility, but you can turn that off by clicking the live transcript button. Next, we've got speaker bios and slides that will be posted at the event page. All participants will be muted, but that doesn't mean we don't want to hear from you. We do. So please type your questions and comments into the Q&A box at any time, and we will lift those up during the presentation. We have a dedicated space where we will be reading from and engaging with questions and comments that you all contribute. And lastly, we will send a survey, so we'd love your feedback so we can get better at doing events. So let's jump in. Where we're going to start is where I will turn to, with thanks, is to Jenny Flores. So Jenny has been supporting this event in her seat at Wells Fargo, where she's the head of small business growth philanthropy. After Jenny, we'll get to hear from my colleague Jorge, and then we will also be turning to the panel, the Q&A, and we'll also get to hear from Seth Julian from OFN a little bit later. But Jenny, excited to have you. Love to have you jump in at this point.
Great, thank you, Brett. Well, hello everyone. I'm happy to join you, and I look forward to the very rich exchange of ideas today. I'm particularly excited about the timing of this conversation because we have an opportunity in front of us to build a more equitable economy and to understand how new investments can strengthen CDFIs for the future. As we gather today, COVID-19 lingers on, and the deep inequities exposed by the pandemic are only widening. We all know the gaps existed before, but they're even more pronounced now. And this moment in time is critical. There's an awakening, a calling to a shared responsibility to build a better financial system where more people can participate and thrive in it. One that is more inclusive and more accessible to people, small businesses, and communities, and more conducive to building wealth, particularly in communities of color. At Wells Fargo, we have long understood the value and the importance of CDFIs. In fact, we've been collaborating for more than 20 years together. Our National Small Business Recovery effort, which many of you know as the Open for Business Fund, was built on the learnings of what worked and what didn't from the Diverse Community Capital Program, which we started back in 2015. So each of our investments build on the others. I'm really energized by the CDFIs and all that you've accomplished already and what is still possible, especially with the influx of new funders. So I want to thank you for all CDFIs, community leaders, and policymakers for being so intentional in our economic recovery and embracing the importance of transformation. I'm glad that we're taking the time today to share those learnings. So now I'd like to introduce Jorge Gonzalez Hermoso, research analyst with the Urban Institute.
Thank you so much, Jenny, and thank you everyone for joining our event today. I just want to spend a few minutes setting the context, talking about the role that CDFIs play during the response to the COVID-19's impact on the economy and how this has prompted new historic investments in the industry. Next slide. So want to take you just for a second back to March 2020. It feels like yesterday, yet at the same time, it feels like it was ages ago. But you may remember we started to see the devastating effect of the pandemic in the economy with those first weekly unemployment claim reports. But there was also a heightened concern about small businesses, these businesses without the financial safety nets that large businesses and corporations usually have to withstand a storm such as this one. We know, according to data platforms, at its worst moment between late March and early April, there was a decline of 32% in consumer spending. We also know from the Census Small Business Poll Survey that in April, every 3 in 4 business owners reported a decline in their revenues compared to weeks prior. And it was documented that 180,000 businesses on Yelp were closed at the start of the pandemic. A sizable fraction of these ended up becoming permanent closures, according to the website. And while all businesses were facing the same storm, not all businesses were in the same boat. Some businesses were more vulnerable to the impact of the pandemic because of the industry they're in, because of their size, their buffer cash in hand, and access to economic safety nets. So this is what we're going to be talking about in a moment. Next slide. However, this historic economic hit was also met with an unprecedented stimulus response. Since the start of the pandemic, Congress has approved $5.5 trillion in stimulus. This includes the CARES Act, the Consolidated Appropriations Act back in December of last year, and the American Rescue Plan. And the $2.2 trillion bipartisan CARES Act by itself is the largest economic package in US history. One of its most significant components was the Paycheck Protection Program, or PPP, which I'm sure most of you will know, which so far has distributed almost $800 billion in loans to small businesses. And this scale of support for small businesses was unheard of. The program channeled almost 29 times what the Small Business Administration delivered in loans in 2019. And this includes all these programs, 504, 7A, those type of loan programs. Of course, PPP wasn't without challenges. For example, by using banks to channel these funds, that meant that many underserved businesses without those relationships with these larger financial institutions, those were sent back to the line, to the back of the line. Next slide. But this is where CDFIs come in, and this is why I focus on PPP, because it really illustrates the might of CDFIs. Not only are CDFIs better positioned and equipped to service those underserved businesses and communities, but they also punch above their weight. So for example, the largest PPP lender is 15 times larger than the entire CDFI industry in terms of assets. This is what you see on the left chart. But this lender only made 4 times the amount of PPP loans in terms of dollars than the 300 or so CDFIs that participated in the program by August of last year. Furthermore, the average loan size of CDFIs was almost half that of the largest PPP lender, which means that they were indeed servicing smaller businesses. Next slide. And we have reason to believe that PPP was consequential in at least keeping businesses financially healthy. Brett and I, with colleagues here at Urban, analyzed data on 1 million small businesses and found that by and large, they were able to keep their credit health. Not only because of PPP, of course, but there were also because of other support programs, including those at the local level, also because of forbearances from creditors, and in many cases, the reduction of payroll costs by letting some workers go. So the chart that you're seeing in front of you, it shows the average share of business payments that are past due. This is a metric of whether businesses have been able to keep up with their financial obligations. And we actually found similar results when looking at bankruptcy rates, credit scores, and other metrics of financial stress. Not a dramatic change from what was going on before and after the pandemic started. And this is important because strong credit health means that small businesses can be well positioned to access capital amid a period of economic growth as the one that we're living in right now. Next slide. So CDFIs have proven they play a critical role in supporting underserved small businesses. Policymakers did take notice during the pandemic when, for example, they set aside $30 billion of PPP funds for CDFIs, minority depository institutions, and small banks. But it is also patent as well by the historic public and private investments recently announced for the industry. Just to name some examples, we have the State Small Business Credit Initiative, which provides funding for programs at the state and local levels to improve access to capital for small businesses, and in which CDFIs will definitely play an important role. There's the Emergency Capital Investment Program, which is a direct investment in CDFIs. The COVID-19 Relief Fund, also a direct investment in CDFIs. And there's a new mission-driven bank fund by the FDIC that will channel private capital and other resources to CDFIs and minority depository institutions. And also, very importantly, commitments from corporate philanthropy. One notable example is the recent announcement from Mackenzie Scott to invest billions of dollars in about 30 CDFIs. And these are only programs, investments directly dealing with CDFIs, but there is also a myriad of programs to support small businesses that have come out from the stimulus packages, in which CDFIs can play a role during implementation, those on the right side of the screen. So the conversation you'll hear now with our excellent panel will draw lessons for the industry from the CDFIs, their role during the economic response to the pandemic, and also they will reflect on how best to utilize these historic investments to catalyze the growth for the field and better service more underserved small businesses. So with that, thank you. And Brett, all yours.
Thanks so much, Jorge, for framing us up. Okay, I want to invite Patrick and Francisco and Richard and Karen to our virtual stage here, and we will get going with the discussion. So by way of intro, Patrick Davis, SVP of Strategy at Community Reinvestment Fund, Francisco Lopez, Chief Operations and Innovation Officer at Dreamspring, Richard Morris, AVP and Senior Program Manager at Main Street Launch, and Karen Omansky, Director of Commercial Programs at Self-Help Credit Union. So I want to start with a lightning round where we get to know the institutions that you're sitting in. Many folks watching will know some of your groups, but maybe not everyone will know everyone. So we'll just go around the horn. Karen, you are in the first seat, at least on my screen. So if you don't mind going and just giving us the quick, biopic blurb on where you sit.
Sure, thank you. Hello, everyone. So Self-Help is a large CDFI. We've been around since 1980. We've got 2 credit unions in branches in 8 states, with more than 150,000 members, which makes us, I think, a little different from some other CDFIs. We also have a nonprofit loan fund and a policy group. We offer consumer loans, residential mortgage loans, as well as commercial loans. And we've done about $9 billion in financing across all of those, and about $800 million in small business lending, which has been primarily in North Carolina and in Illinois as well, in the Chicago area.
Terrific. Going around the dial, Patrick, you're next on my screen.
Yes, thank you, Brett. Nice to be with everyone today. So my name is Patrick Davis from Community Reinvestment Fund, and CRF for short is a 32-year-old nonprofit CDFI headquartered in Minneapolis, but we work kind of all over the country and have a focus on small business lending. Our own lending is primarily SBA related products. But CRF also, I think, uniquely for the purposes of this conversation, we do a lot of work providing services to other CDFIs and other community development organizations. And so we've got a sort of department internally that builds software products for other CDFIs, provides outsourced loan servicing to other CDFIs, and a number of other sort of infrastructure solutions to help smaller and mid-sized CDFIs be able to do more of what they do and do it more efficiently.
Great, thanks. Francisco, I have you as next.
Thank you, Brett. My name is Francisco Lopez. I'm the CEO of Dreamspring. Dreamspring is a CDFI We've been around for around 27 years. We were formerly known as Acción, serving a 5-state region in the Southwest. We're headquartered in Albuquerque, New Mexico. I am based in Texas, and we have several team members that work remotely across the country. And we do mostly small business lending, term loans, lines of credit. We do some SBA lending. We serve now a 19-state region, and we are continuing our growth trajectory towards our 5-year strategic plan towards 2024. So that's who we are.
Terrific. Richard, you're up.
All right, hello, everyone. Welcome on to this great panel and discussion today. Again, my name is Richard Morris. I'm with Main Street Launch, which is a 40-plus-year-old nonprofit CDFI headquartered in Oakland, California. Our mission is to create economic opportunity by empowering entrepreneurs. As a CDFI small business lender, we successfully deployed a total of 81 million in emergency grants and loans to 8,300 struggling small businesses in California during the height of the COVID-19 pandemic throughout 2020. I don't have our full-on numbers, so I won't try to put those out today, but I do know our 2020 numbers. Main Street launched with the keen interest in supporting the local African-American small business community, launched the African-American Entrepreneur Institute with the help of DCC grants and funding. The African-American Entrepreneur Institute, in which I'm an Assistant Vice President, Senior Program Manager, we serve the African-American business community in the cities of San Francisco, Oakland, and most recently Stockton, California. We offer concessionary loan capital, entrepreneur residence, and mentorship programs, and intensive training to prepare more businesses of color for success and wealth building. Thank you for having me.
Some great intros. I'd say great to get to know you, but we do know you, but great for everyone to get to know you and your organizations and the work that you're doing. So I want to start with lessons that we can draw from COVID-19 that the broader CDFI small business community can draw, and the role that these institutions played in supporting small businesses and helping them weather the storm. And I'm sure there are good things to report. I'd love to move past just the platitudes and any stock points to what do you think, sincerely, locally, do you see as the roles you played, maybe any roles that you wished you played or couldn't play? But lay it out for us. What do you see as the role that CDFIs played? And Karen, maybe we'll start with you here.
Sure, thank you. So on the platitudes, I think that a big thing though is we did show that we can be nimble and can adapt, and with a big investment, frankly, have a lot of impact. That would have been a lot harder without that investment. And with that, we were able to get out a lot of these funds we talked about. I think that I'm just going to highlight a couple of key lessons. So one, I think, is really the importance of partnerships, even ones that we may have never considered before. So, CDFIs partnered with large technology companies on one end to really try to reach more borrowers for the PPP program in particular. But on the other end, we also worked with local on-the-ground business support organizations and accountants. And for us with the PPP, that was key to our work because we were trying to reach more borrowers who didn't even know how to approach the system at all to get PPP loans. And it wasn't until we started partnering with these organizations where we really were able to meet the needs of the communities on the ground. And we started that pretty early. I think we could have started that a little bit earlier, but that really helped expand the reach and shows the need for partnerships on both sides. The funders were key partners, and the government agencies and sort of pushing their understanding of the work that we can do and the work that small businesses do that often gets left out of these programs unintentionally. And I would just say a second key point on lessons learned is just the need for continued advocacy. So I think, as Jorge mentioned, and that there are a lot of missteps, I think, in the start with PPP, and it was the work of advocacy. And I think we can't forget that that's really important, that the CDFIs do that and continue to do that with funders and at the government level and with other partners to make sure that, again, the smallest businesses and diverse businesses really do get to participate in these programs and get the benefit of these programs.
Terrific. That was helpful. Richard, you want to come in on what's your perspective here?
Well, first, great points made, and I would second a lot of what she had to say. First, tackling the question around the role CDFIs played in supporting small businesses during this ongoing pandemic. I'm going to echo you, Brett, stating what you stated, and I think in a post. And I agree that CDFIs across the nation have acted as economic first responders during the COVID-19 crisis and continue to do so. Speaking on behalf of the African American Entrepreneur Institute, which is an initiative of Main Street Launch, which was again made possible by DCC funding and grants, we believe that as a result of such funding and support from Wells Fargo and the likes, we, as well as other CDFIs, were well positioned to meet the needs of the small business owner and entrepreneurs in all of our targeted geographies, as Karen stated. The capital provided to our organizations definitely put us in a position to answer the call that was necessary. As an organization, Main Street Launch, again, we deployed 167 grants totaling $500,000 in Stockton alone during the first quarter of 2020 and 180 COVID-19 loans throughout that same year. We were also able to pivot our institute's focus to meet the needs of the moment, providing focus and timely TA services for our network of small business owners. And all, like most CDFIs across the nation, CDFIs were quick to mobilize and find new ways to support their small business owners. As with the lessons CDFIs can learn from the COVID-19 pandemic, I think we all can agree that simply capital is just not enough. So capital alongside pre and post-loan technical assistance are imperative for small business success. In the scramble to access capital, many minorities and historically disadvantaged small business owners found themselves in a situation where the lack of business acumen was laid bare. As a result, many were unable to pivot their operations, access capital, and weather the storm that the COVID pandemic brought. The inability to furnish financials, navigate the loss of labor, and pivot their brick and mortar business models to the online marketplace was too much for many to handle. The lesson I feel CDFIs can draw from the COVID-19 pandemic is that we cannot provide capital only. We must align programs and other TA services with lending for ultimate effectiveness. Thank you for the question.
You're bringing an image to mind. I mean, this crisis, this moment, on the one hand, was revelatory. I mean, we know the challenges, but we were, I think, all collectively confronted with them afresh and anew, and really, again, revealed the foundation that our house is built on, and not entirely a good or stable one collectively. In terms of how we've organized ourselves, not to speak just of CDFIs, but our broader inequities that we've created. Great, thank you, Richard. Super helpful there. So a reminder to our audience that we don't have the chat function working, but we do have the Q&A button. So click that, add your comments, and add your questions, and we'll get to those toward the end of the session. So I want to next get more specific and granular. We've been having good framing, but I want to get to some of the specific ways that we think CDFIs can need help, are making progress, are still in need of progress. And I think that it's easy on one level to say, as a philanthropist, as a policymaker, even as a different stakeholder or partner, CDFI is great. I'll give you loan money and you go and you make loans. But I have a feeling that most people who sit inside a CDFI say, yes, we do need loan capital, but we also need money to support the infrastructure that helps us to deploy that capital. And so I'd like to talk about that and what it is that you're building and how it is that you built it. So let's start with technology, which proved to be a way to respond to the crisis and to do so at scale. But also there's probably some gaps and opportunities. So Patrick, do you want to kick us off there?
Sure, thanks, Brett. So I think that, it was mentioned in the earlier remarks, we've definitely seen CDFIs out of necessity, partnering with various technology service providers to try to step up and meet the demand, which has been, orders of magnitude larger than we've seen in the past. So everybody's pipelines are extremely full. Everybody is dealing with tons of customer support issues and questions, just at a volume that they've never seen before. So we have seen CDFIs get really scrappy and do interesting things to respond. And I think these are great because we're stepping up to try to figure out how to meet the need, but these are Band-Aids and not long-term solutions. And so I'll give one example. We have a partner CDFI that was a part of a loan program in the South and Southeast part of the United States. They were getting so many requests for access to, and this is a private loan program, that they just couldn't handle it. They decided to reach out to some HBCUs in the region and just recruited some college students to be the first line of defense on the phones. And what they found was the conversations that these college students were having with small businesses were extremely robust, productive. Even some of the students from the HBCUs that weren't necessarily trained around this were so passionate about figuring out how to help small businesses in this moment in time, that they were really effective and figured stuff out. And so that organization has now created a permanent internship program with several HBCUs. And I think that is fantastic. To me, that speaks to how a CDFI would normally go about solving these kinds of problems. And I think we have to keep that spirit of collaboration and openness to finding new kinds of partners. But we also have to think in a really smart way about how to handle the capacity challenges on the operational side. And so we've also seen other CDFIs develop partnerships with call centers, which might be something new for our space. But thinking about how do we offer 24/7 customer support to small businesses, many of whom need customer support at midnight or 1 a.m. when they're not working on their business. So I think there are several technology solutions and ways to approach the challenges around scale and the needs around operational capacity. And I think we need to start thinking about those investments that need to be made for the long run and not the short-term Band-Aids. And so I think we're starting to see some of that, Brett, but I'm not sure that there is a comprehensive and sort of cohesive industry strategy around how to effectively develop technology that's going to serve the communities that we care about.
Very, very helpful and provoking us to think and do better there. We're going to come in just a minute to you, Francisco, because I know that you have a lot of thoughts that are on point for this too, but just say, if you would, a word more, Patrick, about the anecdote, if you will, of the Activator grant, because it felt like that helped accelerate some of your progress on the tech side. It just happened mercifully to coincide with COVID, with PPP, but build that out as an example for the group so they can see what change can look like in a practical way.
Absolutely. So the Wells Fargo Activator grant was really a huge source of support for CRF in developing two technology platforms. And CRF is a bit different than some other CDFIs in that we do have a full, software development team internally that's building software from the bottom up. The support from Wells Fargo enabled us to make longer term investments in human capital, build that team out, and in the infrastructure that supports the technology we're building. And in particular, that's because of how the grant was structured. So this was a 3-year grant, not a 1-year grant. So we had runway to understand, what decisions we could make over time around the long-term investment that needs to be made. And a lot of CDFIs know this, and I think some funders and philanthropists understand this, but unless a grant is structured to be a multi-year grant, you have to recognize all the income up front, but you have a lot of expense over time because you have investments that need to be made over time. So unless the philanthropic sector and the public sector actually create the certainty and confidence for CDFIs that they can make these investments in the short term and the long term, I don't think we're going to have a ton of success. And then just quickly, Brett, on the point around the technology that CRF has built, it couldn't have been more timely, and in retrospect or hindsight is 2020, but we got the grant from Wells Fargo just in advance of COVID hitting, and we were able to make significant investments such that we were ready to step up to the plate during COVID. And so as a result of that, we were able to facilitate more than $7 billion in PPP lending through our Spark platform, which is optimized for SBA lenders. So it kind of came out of the box supporting other CDFIs that wanted to do PPP lending. And then we also made significant investments in a platform called Connect to Capital, which has been used to coordinate regional responses with cohorts of CDFIs, collaborating on the same platform to deploy capital to the smallest of the small businesses and to those in the LMI communities that we serve. So timing was lucky, Brett, but it worked out really well, and we're very gracious for the support from Wells Fargo.
Thanks for that. The specific example there, and tongue in cheek here, in News Alert, we're learning that big grants that are multi-year and without many strings attached are helpful. So good to hear that confirmation. And yeah, really fortunate timing for a lot of businesses in a material way. Francisco, let's turn to you, because I know you've been doing a lot of work on the tech side.
Thank you. I really share and echo everything that Patrick said. I think that we found ourselves in a very similar situation. Dreamspring has been investing in its own technology since back in 2017. 2019, when we rebranded, we finalized kind of the bigger phase of the development of our own proprietary lending platform. So it coincided perfectly with the start of the crisis in March 2020. We had already started to engage with a couple of fintech marketplaces to be able to reach more and more businesses across the country. And we were already in a very good cadence in working with those fintechs. So when COVID hit and we needed to convert ourselves into economic first responders, we had several channels already open that allowed us to provide access to small businesses everywhere. I think our technology responded well. We continue to develop it. We want to take it even further. We want to convert our technology into something that is very, very or more nimble, that allows clients or us to adapt to our clients and to the needs of small businesses. We don't want to see ourselves and our technology to enable only one type of loan, but really to be able to enable the type of loan that small businesses need. And for that, we continue to also work with our own in-house development team to achieve that. I think that the whole industry, as well as not only in the CDFI industry, but all across financial services, we saw this shift in using technology that was either in development or readily available to respond. And some of that new technology has stayed permanent and will continue to be permanent and continue to develop. So just a simple example, before August 2019, we had to do all of our closings in person. And just with a simple change in our platform, we shifted from doing in-person closings to doing them virtually. So that played a significant role when the crisis hit. Just a small example of how important development in technology is, investment in technology. Moving forward now with the recovery phase upon us, it'll play even a more significant role.
Love it. And I love the specific example there. It's helpful, I think, to get under the hood a bit in terms of what it really takes to do this work and to do it well.
Brett, if I may, what Patrick and Francisco just stated is pretty similar to Main Street Launch's ability to pivot with the support of the DCC Activated Grant. It actually enabled our organization to develop a new cloud-based technology and process that enable remote grant deployment and loan deployment at a crucial time period. And in all honesty, the COVID-19 pandemic, in concert with the key word, I think you hit it earlier, the flexible activator grant, which supported CDFIs like ourselves with pivoting when we needed to. It helped us create an opportunity to convert a crisis to an opportunity with the new end-to-end system for grant and loan deployment, which it sounds similar to what Francisco's organization was able to also do. So I definitely just wanted to chime in on that and just say what a huge benefit receiving that DCC grant provided our organizations and supported our ability to answer the call and also continue on outside of the pandemic with this new capability, cloud-based lending system.
And to anybody watching and thinking this is either easy or every CDFI has figured this out, I'll just say no. Okay, Karen, I want to come to you. Apart from tech, how CDFIs can improve services, achieve better race equity, capital access for small business owners?
Yeah, so I'm going to build a little bit off the tech piece. I think the one piece that can sometimes be difficult to integrate with that or just take some work and thought is the relational piece. And in a lot of the communities that we work in, that relational focus is key to building trust with the communities. Many communities, they've learned not to even ask for a loan because they just assume the answer is going to be no. And so CDFIs, I think for the most part, do a good job of that, but I think that there's a lot of work that we need to continue to do. And so I think when we're thinking about technology, there has to be that piece that goes along with it to think through how do we get that relational part for those many small business owners who still need that and want that. And our PPP lending work, and then I'll talk about another example in a minute. We had borrowers, we needed these relationships and partnerships because they struggled not just with the technology, which was pretty easy online application from a general perspective, but also just the SBA forms. And so I think making sure that we have a way to also think about those relationships and that relational piece of it. Another part that I think is important and just illustrates this is this. So with the Wells Fargo grant, we actually had started focusing on contractors, small contractors who want to grow, because that's also been a huge issue. And what we learned is they need a different type of financing product than we may offer, and a lot of CDFIs might offer. They have quicker timing needs, and some of them really need this business support to better track their jobs, to sustainably manage their growth, to learn of government contracting opportunities. We did a lot of work up until the pandemic. They sort of got put on pause, but with the state and with other partners to provide that support and this ongoing process. And for construction projects, we even talked about, could we finance the first tier contractor in a way that provides funds to be distributed to the second and third contractors to get them supplies or whatever's needed up front. But again, we need that relationship with those contractors, those first tier contractors. And we could then underwrite the whole product. And so all the whole project, and all that is really messy. It takes a lot of time to meet with business owners, to build the relationships, to try out the ideas, frankly, to then fail with some of the ideas, to learn from those, and then to try something new. And the staff capacity, building the expertise, I mean, that's to me where this grant and these opportunities, something besides finance, is really needed. I think now coming not out of the pandemic, but with infrastructure, with a lot of other work, we're hoping that this contractor work that we started can continue and help these small businesses. I will say that House recently passed a bill that may not go anywhere, but has a number of measures to support some government contracting for small businesses with incubators at historically Black colleges and universities, and prime government contractor TA help. And so that's the kind of thing that I think is really needed. And I think the part that made this all useful, just sort of a couple points that public and private sector can support, is really just these grants to CDFIs to experiment with this out-of-the-box lending models that reach underserved borrowers, and to be able to take the time, as has been mentioned by others, with these longer-term grants. And then another thought is just having a focus particularly in government lending and guarantee programs, on capacity to repay versus collateral and equity, given the well-documented racial wealth gap. And so I think that's something that's going to be really important as they think about how to expand community advantage and other SBA programs.
Wonderful, thanks. one shout out, drawing in a comment from Storm, which is in the Q&A. Hi, Storm, thanks for this, saying she agrees, and it's important to pair lending with other eligible uses for these groups, that the lending is not enough. We need technical assistance, staff training, IT, and infrastructure investments, sitting from the NELCAB hat. So Richard, let's come to you on this question. And in particular, you mentioned the African American Entrepreneurship Institute, but could you help us understand, specifically how it is that you think that is improving outcomes for the owners that we care about? You're on mute, Richard.
Sorry about that. First and foremost, the saying goes, it definitely takes a village. CDFIs must focus on building out ecosystem of strategic partners to build the capacity needs necessary to effectively serve the local small business community. In our case, the African American small business community. We at the African American Entrepreneur Institute not only believe this to be the case, but employ this model of expansion in our work. Moreover, CDFIs need to foster a culture of fluidity in their organizations. Fluidity that would allow them to pivot their service offerings and capital products as needed to meet the needs of their clients. I think the COVID-19 pandemic was a great example of the need to be able to do so, to be able to pivot. With the help of the activator funding, our institute partnered with the city of San Francisco, for example, to launch the city's first African American small business revolving loan fund in 2020, which has since deployed over $2 million in loan capital in the midst of the pandemic. This was an opportunity that was made possible as a result of our leadership's willingness to partner with those in our ecosystem and placing the necessary resources, which was also made possible through the capital, the funding of the DCC capital grant, resources to ensure successful launch and execution of the capital program. Our institute's focus on evidence-based research, I believe, sets us apart as well, to identify and communicate trends, developments, insights, and best practice in the local ecosystem is how we see our organization improving our service offerings to achieve better racial equity and access to capital. An analogy that I use sometimes, not to get off too topic, but we have to see our small business community as a freeway, right? So you have different lanes. So you have small businesses that are emerging, that have this idea. Then you have some that are startups, emerging, and legacy businesses. And as a CDFI or any organization offering any type of service, I feel that it's very important to pick your lane. And once you understand what lane of small business in regards to the capacity that or industry or what have you that you're serving, you create these ecosystem of strategic partners that can help you grab around all of the lanes. So you as a one unit can support that effort. But I hope that answers the questions.
Yeah,
I'll be more than
awesome. It definitely does. I want to draw in a couple of Q&A questions, and then we'll hopefully have a wrap-up question as well before we pass it to Seth. I got to start with the question from Mary Miller. Mary, hi there. Thanks for joining. Mary's a trustee at the Urban Institute. So in a way, she's my boss. So I got to start there. But it's also a great question. Can, or maybe to what extent can CDFIs be self-sustaining financially from the revenues that they're generating, or are subsidies required? Is it required on an ongoing basis or more for these catalytic investments in things like IT? And to what extent can economies of scale help, as well as technology? So if you could just take very quick, all right, Francisco, you're coming up first, but just very quick response from where you sit, Francisco.
Yes, I think they can, and I think they should at some point. No, so I think that every CDFI is in a different position in their own journey, but I think that with the investments that are being made, investing in technology, one of the focus or targets for the CDFI is to be self-sustainable. I think that is the ideal scenario, because then any additional funding, philanthropic, et cetera, can really, really be leveraged for impact, right? Instead of trying to sustain and subsidize the CDFI. If you do get to that point, everything that is invested for impact will be dedicated to impact. And I think that's the ideal scenario.
Anyone want to disagree or agree?
I would just say I agree.
I agree too. I think it sort of matters. As a CDFI, you kind of have to, I guess, to build on Richard's comment, you have to pick your lane, right? If you're growth oriented and you're thinking about how to scale, then I think the goal should be to break even, at least as an organization, in the long run. And there's ways to do that, and there's business models that could support that. But if you're a community-based organization that is really focused on deep impact and is taking on activities that we know are not going to pay for themselves, then there might be a ongoing subsidy requirement. I think the biggest thing for a lot of CDFIs is they're not sure which lane they're in. Are they growth oriented, or are they a smaller community-based, impact organization that's really thinking about those non-revenue generating activities?
Great.
I thank you for that, Patrick. I would say, a little bit of both. Focuses, impact as well as disbursement of the capital. So, and to be self-sustaining, because with creating impact through services and programs such as the African American Entrepreneur Institute that's focused on pre, post-loan TA services, mentorship, you're actually creating a pipeline of small business owners that would hopefully access the capital that you have and be able to sustain and service that debt. We're seeing, again, once COVID-19 put the hood on all of our small business owners, a lot of them did not have the acumen to not only withstand the pandemic, but were probably not sustaining in the current state. So the focus on providing that extra service around technical assistance, sustainability, with the ultimate goal of intergenerational wealth creation, I think you're going to create a sustainable business model because that pipeline of business owners are coming through that program or that service, sound and ready to take on that debt.
Great. So now we have more questions than we have time for. So I get to the painful point of the moderator role where I have so many good questions I want to ask and I can't get them to all. So maybe we'll try to have just one person answer each question to start and see if we can get through a couple. Just quick follow-up on this immediate discussion from Eric Weaver. Thanks, Eric, for this. Are people aware of what kind of rates and fees will be needed to make CDFIs growth-oriented sustainable? Or do you think there's confusion on that? Let me send that to, all right, Francisco.
I think it's, I agree that is a path, but then there's also investment in technology can make the process much, much more efficient. Not only the lending process, but the client acquisition can also be much, much more efficient. The outreach can be much, much more efficient. Partnerships, economies of scale can allow you to get to that point and not only have to depend on increasing interest rates. No? So I think at the end of the day, you want to continue creating and scaling the impact in the same way that you have done historically, but just doing it in a much, much more efficient way and with economies of scale, of course.
Okay, an interesting back and forth in the Q&A. Thank several of you about, is sustainability the goal? Is this a goal we impose on others? So I'll let you follow that in that thread. I wanted to lift up Jeffrey Ash's question at the top of the list here. Have CDFIs been leveraging social capital, improving loan to immigrant businesses, especially things like informal savings circles? Do any of your groups have experience in that? And do you see a role for CDFI small business lenders in that space? Maybe just one person can tackle that.
Yeah, so this is Karen. We definitely do loans to immigrants in the immigrant community, a fair number of them. They're members in our credit union too. We use the products, obviously, and programs that they are eligible for. It's interesting, years ago, we did many years ago, we partnered with an organization that did some of these lending circles and worked with them. But we haven't in nowadays the immigrant community. We just sort of serve them as their lender. They're often members, and then they come to us for loans. but that's part of our standard line of business.
Great. Okay, great. And then so many other good questions, sorry, but where I really want to get to before we go is a bit of a step back and a look forward. I promise that, put that in the event title. And what I want to know is we really have had a series of unprecedented investments in CDFIs from high net worth individuals, from corporations, from the federal government. And I want to know, based on your take, and you can each have less than a minute, sorry, to get to this, is this an inflection point? Or is this just continued progress for the industry and the sector? And yes, these things help. But is this actually an inflection? Are we actually turning some curve here that we're going to look back in 10 or 20 years and say that was a moment, like we really moved forward, or less so? And you could weave in what might be needed more to make that the case if you're not sure that we're there. Happy to hear from any or all of you quickly on that.
Sure, I'll jump in. I'll be a bit provocative, Brett, because I'm sure you'll appreciate that. I think the jury is out, but I'm concerned that the stimulus will be a source of short-term subsidy that's used to address the same business model challenges that CDFIs have had for decades. And if that happens, then we're just buying time, and we're not really transforming the way that we serve the communities that we care about. And so I think there has to be a level of rigor for those in philanthropy and the public sector to think about how to put some guardrails in place to ensure that CDFIs are using the scarce dollars that are, once in a century dollars here, to think about how to update and improve their business model, their approach to clients, all of the customer experience, all of these things we're behind and we got to catch up. And so I think it's incumbent on CDFIs, but also on folks who are providing the subsidy to ensure that it's not just going to be a short-term stop loss and we're in the same place 5 years from now.
Love provocation. Anyone else want a last word on inflection, not inflection, buying time?
I feel that we are in an inflection point. I think that with what has happened the last 18 months, the CDFI model has been validated. It has proven that it can be effective and it can respond and it can adjust and be flexible and can be prepared for what's coming up next. So I think that it is definitely an inflection point. I mean, just the numbers speak for themselves, and the level of outreach and reach that the CDFIs had during the last 18 months, I think represents that.
Awesome. I know there's so much more that can be said. Hate to pause, but some good suggestions in the Q&A for future event topics on this theme. So hopefully more to come. But Seth, I want to turn it over to you, not just for thanks, but a substantive reflection on anything you want to add about whether this is a moment, how we move forward, policy, wherever.
Yeah, thank you. It's been a really interesting conversation. I've just been trying to think what to say. So first, I want to do a couple of thank yous just to the panelists. To Wells Fargo. So you're hearing really from 4 CDFIs who participated in the Diverse Community Capital Program. OFN is kind of the administrator of the program with Wells' support. And I really want to give a shout out to Alba Castillo, who is really the OFN manager of this program. There's over 100 CDFIs that participate in the social capital aspect of it. So it's a really great opportunity here for all of those CDFIs to kind of network and collaborate. So I guess a couple of points. So one, this is absolutely a moment for CDFIs. I mean, if you look at just the tremendous amount of exposure that CDFIs have gotten over the past 18 months, it's pretty tremendous, right? So we have, just a ton of investment from corporations, right? So Google, Twitter, Amazon, Square, PayPal, et cetera, are all investing in CDFIs, whether it's a depository or non-depository. You have on the federal government side with the CDFI fund and the CARES Act and the stimulus funding, but you also have CDFIs right now with potentially playing a really large role in the state small business credit initiative program. You have CDFIs kind of mentioned in the infrastructure bill. There's just all this momentum kind of gaining on the public side. On the state side, many more states are getting involved with CDFIs just through the pandemic. We saw lots of different states have programs, whether it's just direct kind of grants to CDFIs or guarantees that they would provide to CDFIs on lending. So a lot more states are getting involved. On the philanthropic side, like Mackenzie Scott has just given CDFIs a ton of money, but also just our traditional kind of philanthropic partners. So you start to add all, like, I don't think any of us would have thought 18 months ago that this is kind of the exposure that CDFIs have gotten. And I just want to give a thank you to all the PPP lenders out there who kind of lent to really entrepreneurs of color, like that activity that all of the CDFI PPP lenders did and kind of proved that CDFIs like lend in to communities where other financial institutions don't, is really the crux of all of this momentum. So thank you to all of you who kind of participated in that program. I know it was challenging. I know it's a lot of kind of staff hours and office hours, but all that work that you did has really provided this lift that we're all feeling right now. So with this being a moment, it's also just a tremendous opportunity, and I'm really curious to see kind of where we go next. There's still a lot of kind of activity that we're seeing from all of these different sectors and getting involved in the CDFI industry. And we kind of need to continue that push. There's a lot of really interesting conversations happening. The question that came up about can or should CDFIs be self-sustaining? And I think that's one that we've had in the industry for a while. I think we are under the impression that subsidy is needed just in the communities that CDFIs work and just kind of their business model. Many of them will need subsidy to probably go deep and reach the communities that we want to reach. And that being said, there probably are a few CDFIs who the business model is a little bit different. I think that's really all I want to wrap up with here, Brett. I mean, it is a really, really wonderful opportunity that's in front of us. And we have just a tremendous both challenge and opportunity in front of us to kind of continue this going, continue to get money into communities that need it. And it's exciting. It's exciting for sure.
Thanks so much, Seth. And thanks everybody for joining. All the best.